Hello and good evening. I call this Board of Finance meeting to order. And I actually just lost my spots. But welcome. Sorry. Well, good thing we went live before I have myself together. Let me make sure I can find myself.
It's like a Monday today, I think.
Oh my goodness. So county business, sorry, I'm lost in my own. I thought I had everything open and then of course they don't. Governance, there they are. Okay, sorry. Thank you for your patience. Call this meeting to order. This February 22nd, 22 virtual meeting of the Board of Finance to order. We do have the minutes of the November 9th, 2021 Board of Finance meeting, last meeting minutes. Hopefully everybody's been seeing that. They've published. I move to approve the November 9th, 2021 Board of Finance minutes. Can I please have a second? Commissioner Quesada for the second. County Manager, please call the roll. County Clerk.
I got an upgrade, did I?
County Manager's turn. Let's see if she knows our names. County Clerk, please call the roll.
Commissioner Quesada.
Aye.
Thank you. Commissioner Piscotti.
Aye.
Vice Chair Benson.
Aye.
Madam Chair Barboa.
Aye.
So called.
Great. And as the Board of Finance report for February 22nd, we have Madam Treasurer to present. Take it away, Madam Treasurer.
Good afternoon, Madam Chair and members of the Board of Finance. My name is Nancy Burse and I am your Bernalillo County Treasurer. Before I begin my presentation, I do have a few new faces to introduce. And the first one is that you'll see is the new Deputy Treasurer, Ryan Travelstead. And that should be a pretty familiar name. He's been with the county for a while and been with the Treasurer's office for several years now. Ryan, do you want to wave or say a few words?
Yes, thank you. Yeah, I've had to figure out how to get unmuted there, but yeah, thank you for the introduction, and I'm happy to be here and humbled at the opportunity to serve in this capacity.
Thank you very much. And also we have new Investment Management Services Group, Government Portfolio Advisors, headed by Deanne Woodring, the president and co-founder, and Garrett Cudahy, who's the Chief Investment Officer. Deanne, would you like to say a few words?
Thank you. Thank you, Treasurer and Board. It's a privilege to be in front of you today and meet all of you. GPA is really looking forward to working with the county. We have a depth of experience in New Mexico and look forward to meeting you all.
Thank you. All right. So this is the Treasurer's report to you for the quarter ending December 31st, 2021. In this report, Madam Chair and members, you'll see our former investment group reports, as well as a new deck of slides from GPA that are using their format. This report will be a transition report, but we hope still very transparent for you and the public. As we open up, there's your agenda on the report. The reports indicate all that we report out to you and to the public. Next slide. And the first slide is how we're doing on our property collections. Again, this is December 31st, And you're going to see the 3 years there. We added 2021 because we did have the new 2021 property taxes mailed out. So you see, 2021, we were charged with collecting $778 million, just a little bit over that. And what we collected as of December 31st was $239 million. So we didn't get much going. And that's because we had 2 tax delays. Don't forget that. We did have MESD, which stands for Moriarty Edgewood School District. That's the last and final out-of-sequence school bond voter initiative that'll be on the November ballot. And this school district covers parts of 3 different counties, including Bernalillo, Santa Fe, and Torrance County. And I say we had in our bullets there 2 tax delays, and probably the clerk is getting ready to throw something at me. No, she's not. She's being very nice because that was such a close election, the Moriarty Edgewood School District, that the close vote kicked off an automatic recount. And the automatic recount, of course, is in 3 counties. So we had 3 county clerks that were recounting that vote before we could have the final certification from the Secretary of State. Because of that delay, I did have to ask for a second delay for those parcels of property that are in Moriarty Edgewood School District. I only thought it was fair that if the vote was that close, that we go ahead and extend it and not send their bills till later. So you see the dates there. The initial delay was December 1st for mailing, and then because of the delayed count or the recount, we mailed out Moriarty Edgewood School District on December 10th. Next slide. Because again, we were so late in those delays, some people didn't even have a month yet by the time this report is done. You can see in 2021, just almost 31% is what we collected by December. But again, we have an update for you later on about that, so hang in there. Next slide. Some things about our operations internally there. You can see the call volume in the blue and orange bars there. And you can really see that really when we compare this to last year's 3rd quarter, it really wasn't until December that you saw the call volume go up. And that makes sense. People were looking for their bills November 1st. They're like, why did I get this bill late? How am I going to pay it? Are the due dates extended? So we got a lot of calls in December. And you can see that in that graph. Underneath that, the delinquent account turnover, again, remains the same until our next reporting cycle in the summer for you. The big chart of delinquent accounts, or delinquent collections, excuse me, it's kind of interesting because this year, really when we compare it to last year, October was the only month that we did better in 2021 than we did in 20. So we're still kind of shaking our heads on that and don't understand why. But again, there were certain things that were happening with COVID and with the economy, and we think those are the reasons why. Next slide. And you look at our property tax distribution, not much change there. It stays pretty much the same. A little bit more went out to education, 34% there in the green, but everything else pretty much stayed the same. That really doesn't change that much, but there's your categories of what went out to the county, what went out to local governments, the cities and villages, what went out to health, the UNM hospital, the environment with the NAFCA, the Middle Rio Grande Conservancy District, and we do have the east side. Actually, it's the Edgewood Soil and Water Conservation District in the state. The state does take out bonds, and so they get 4% of our taxes. And I think the next slide, we're going to switch over to some balances and collateral and change over to Deputy Treasurer Travis Beck.
Thank you, Madam Treasurer, Madam Chair, members of the board. This slide here details the bank balances in the operating and investment accounts that the Treasurer's Office has. Each bank account is split out with the blue heading there. The final line in each section shows the uncollateralized and uninsured balance of each account, and I'm pleased to say there is no balances that are uninsured or uncollateralized. So we meet the statutory requirement of 50% collateral, but actually since this is a snapshot in time, the collateral balances change regularly with the balances. And so as of December 31st, all of the accounts were fully collateralized and fully insured. And this next slide here is just a brief high-level economic update. There's several kind of mixed results that are out there that could potentially impact or could have an impact on the investment portfolios. On the national level and the New Mexico level, it's showing positive trends on the GDP side for that growth. The unemployment side is still maybe a little lackluster. We're still down some jobs compared to pre-COVID levels. And then basically some of the main concerns that I'm sure that everyone's aware of is inflation and then some of the supply chain disruptions that have been occurring. This slide here breaks down our investment portfolios. It's broken into 3 buckets, one bucket being the highly liquid bucket, which represents 15% of our operating budget, and that matures within 30 days. So very liquid. The next bucket is our liquidity ladder bucket, and that is $60 million minimum that matures each month. $5 million matures each month. And then the core portfolio, which is actively managed. At this point in time for this report, this was when PTA, Public Trust Advisors, was still actively managing this portfolio. But as we'll go into later, the new investment advisor, GPA, will be taking over actively managing that portfolio. And this slide here details the bank account holdings that we have by portfolio or by bucket. As you'll see there, we have a total of $859 million in market value as of December 31st. And the reason that 859 is a little higher than usual is due to the property tax collection delay. So as there's a delay from when we collect the property taxes and when we send them out to all of the entities. So during that time, that money is invested. This details the liquidity ladder. Again, shows it's a smooth ladder of $5 million maturities. The portfolio currently reaches to March 15th of 2024. And again, this details the liquidity ladder holdings, currently sitting with a market value of around $137 million. And again, these slides come from the previous investment advisor, Public Trust. And so the next quarter's report, these slides will look a little bit different. Next, we'll move into the core portfolio. So here, this core portfolio is benchmarked to the Bank of America 0 to 5 year Treasury Index. And then again, this strategy each quarter is approved by the county treasurer and yourselves. And this details the holdings of the core portfolio, and currently sitting with a market value of around $141 million. And this details past performance. Again, just a snapshot in time as of December 31st. Next, we'll transition to the bond proceeds portfolio. The bond proceeds portfolio is managed to a draw schedule, an anticipated draw schedule. We work closely with the finance division and to project when the funds are going to be spent for different projects that voters have authorized the county to sell GO bonds to finance. And again, as of December 31st, this particular portfolio has a market value of around $42 million. And then this next slide here is a way to rate what we're doing. And so as I'm pleased to announce that through the first half of fiscal year 2022, we've earned roughly $2 million in investment income, down a bit from last year, and definitely down relative to fiscal year 2020. And that is due to the kind of rate environment that we have been in since the pandemic began, and kind of a lot of the uncertainty associated with that. And now, if there's no questions, I'll transition back over to Madam Treasurer.
Thank you, Ryan. Yes, I just want to thank Commissioner Benson. Because again, he's been appointed to the investment committee. So I know we always like him on the investment committee. He asks wonderful questions, very insightful, and we appreciate Madam Chair making that appointment. So thank you very much, Commissioner Benson. Also, just wanted to really bring you up to speed really fast on what happened with the cyber attack, because as you know, we were hit January 5th, and we were down. Simple as that. And as we started to come back up and we had our systems back up, we had to do something with about 18 days worth of backlog. And we had to work really fast to get those in and get those processed. People were calling, asking, you know, I sent you my check, but it hasn't cleared the bank. What are you all doing? And many people were very unaware of our cyber attack. So all hands on deck, and our cross-training worked perfectly, where we had a lot of people filling the cashier area and just working those fingers to the bone and processing payments. So you can see there, we broke it out into the total amount for the first half, the backlog amount, and then I wanted to come up with some percentages to help you understand. But you can see just in that middle column there, the mortgage companies, of course, were the largest amount of backlog. And that's because they sent theirs in the last week. And the cyber attack happened the last week of our collections. So $147 million had to be processed for our mortgage companies, the escrow and title companies. We had the drop boxes, and still had Rio Grande collecting for us, thank goodness. And those teller in-person drops amounted to almost 25 million that were backlogged. When we look at our lockbox, they were continuing to receive mailed in payments to the tune of 16 million. And then of course we had our online payment services through Point and Pay, as well as our direct pools from bank accounts that paid us almost $9.8 million there. So that was almost $200 million in backlog that we accomplished processing in 10 days. And to me, I was just so excited for that ability and that kind of expertise and professionalism we have on staff. And we threw a pizza party. And I put these figures up on the board for them. so they could really see how well they did in processing. So you see on the percentages in that far right-hand corner, 53% of our taxes were collected out of the 778 million. So really, big hand for Treasury staff. They really came through for us. So thank you, thank you. Next, we do have the government portfolio advisors and their packet of information. And I'm going to turn it over to Deanne and Garrett. Thank you so much.
Thank you, Treasurer. And I just need to test Garrett. He's not sure that his video audio is working. Garrett, can you speak, please?
Yeah, can you hear me?
There you are. Okay, perfect. Garrett is with us. So again, I'm Deanne with Government Portfolio Advisors. GPA was founded on the purpose of partnering and collaborating with our public fund clients to help empower your investment programs and ensure that every point is on where it needs to be, and really looking at it as a holistic process. So we currently have taken on the portfolio as of February 6th. We had about a month transition period where we worked in collaborative with both PTA and transferring over data to us, as well as, of course, with the Treasurer's Office and the County Manager's Office to make sure we had everything on point for this transition. So I'm pleased to say that we reconciled and everything's balanced through. So if we can go to the next slide. So one key element that we're really focusing on for this next month or two before the next meeting will be to really look at your overall purposes of your funds and driving the structure of the portfolio to align with those purposes. Every dollar you have is budgeted for something. And so we really want to build out and make sure that with that budgeting and where those are aligned, that the portfolio is invested in the proper balance to those objectives. The other thing we'll be looking at is your policy review, which isn't slated till August, but we'll be working on that to provide to the Board of Finance any recommendations that we have that align with the 61010. And there are some items, so we'll be bringing some educational support to that as well. When we look at the operating fund, there are the three components: the highly liquid, the liquidity portfolio, and the operating. And we're currently managing within the parameters that you have established. And we'll continue to do that as we go through and look at the investment strategy themes and ideas that we'll be focused on. And then the bond proceeds portfolio is there to support just that, the bond proceeds. And we're working closely on the needs and then presenting our proposals as needed for that. The key points that I wanted to bring forward today, we don't have our reports because we just started and we're tying out for February, but safety, liquidity, yield, and risk. And those are all elements that are the standards objectives of your policy. And I wanted to just pull in a couple items that we're looking at to make sure we have the history, we have the expectations going forward, and how we here at GPA address these three objectives and add one element. So safety is managing your liquidity. How much do you need for your daily operating funds? How much do you need for payroll, debt service, etc.? We also manage safety through understanding the maturity and the constraints that are applied by policy, as well as market exposure. We also apply asset allocations. You guys are pretty minimal in utilizing all the asset classes that you're allowed to have, and it's totally appropriate where you are. But we will be looking at some other alternatives that are allowed by 61010 to see if there's a nice balance that will enhance the portfolio structure going forward. When we look at liquidity, we want to always maintain the right number for liquidity and to have a big haircut on that. So that's a big part of our analysis at the outset, is understanding where the minimum can be, where we want that to be, and is there any opportunity cost by leaving too much liquidity. Right now, you're very healthy, as many of our public funds are, and so we will be focusing on the balances that you're keeping very liquid and seeing if there's some investment opportunities to diversify that structure. And that also ties to cash flow. You guys have a very in-depth cash flow analysis that you already have. I have a lot of that on my desk and looking through and making sure that as we build out the strategy that aligns properly with your cash flows. And all that information helps to bring confidence and transparency to the structure and the investments overall. When we look at yield, it has to do with yield maturity structure, those asset classes, and the positioning. And what's really great, as I'm sure you're all reading, is interest rates have moved up substantially. And Garrett's going to touch on that in just a moment. But the yield will really benefit those earnings numbers that you're seeing. We've more than doubled from last year to this year more. And we certainly have a lot of uncertainty in front of us going forward. So we're really excited to be able to bring that to the county, and we look forward to helping to enhance those returns going forward. And then the last pillar that we always look at is risk. We are very focused on both interest rate risk, credit risk, and reinvestment rate risk. You have a piece in your policy that addresses risk tolerance. So we'll be vetting all that out too as we build out recommendations or any changes with all that support behind it. So this is just kind of a brief footnote for the board here and looking at historical balances. So we were able to grab historical data from your previous advisor going back to 2018. And the key with this is the elements of that operating fund. The yellow is the highly liquid balances, the green is the core balances, and the blue on the bottom there is the liquidity balances. So we'll be working with all three of those components to have them ebb and flow together to really create an effective, stable portfolio for you. You can all see how the liquidity is growing quite a bit, and that will be the area that we're focused on to see if some of that should be invested into the intermediate investment portfolio. And with that, Garrett, I'm going to have you just cover, this is a little stale now since it's 2 months in after year end, but just touch a little bit on rates for us, please.
Yeah, excellent. Well, good afternoon, and thanks for having us. We look forward to the relationship for the years to come. But what a wild ride these last 2 years have been, and the interest rate market kind of picked up that torch here for the last 6 months before the recent escalations over there in Eastern Europe. But really what happened was, for the longest time, nobody was expecting anything out of the Federal Reserve as the malaise of the COVID pandemic continued to hang. And everything changed a little bit with the inflation readings, but mostly, and Deputy Treasurer Travelstead mentioned, there's still about 3 million people not employed today that were employed pre-COVID. And because of the strong demand for labor, given the strong economy, that caused wages to accelerate in a trend we haven't seen in a long time. So that really is what caught the market off guard, is the one surefire way to keep high inflation high is to pay people enough to keep it high. So the market took a dramatic turn. Yields moved notably higher, especially in the very front end. The 2-year note is sitting at December 31 at 73. It's 155 sitting here right now. And ironically, about 1 year ago, it was only 10 basis points. So what a change we've had. Another thing to note is the curve has flattened out to levels that you typically see toward the end of a Fed hiking cycle, not the beginning of a hiking cycle. And what that means, and what a good time to look at your highly liquid balance of maybe shifting that in the cores, that's the market's way of saying that most of it's priced in. We never know that for sure. There's, of course, uncertainty, but the bond market's largely recovered back to levels that existed pre-COVID. And by and large, that's where the market expects the Federal Reserve to normalize policy back to once all said and done in the cycle. So yeah, a lot of movement on yields, but this is very good. And I always explain to clients that looking backward at some of your portfolio holdings may not be joyful, but remember, yields today defines most of your return going forward. So bright future ahead, and we hope this cycle will last a little bit longer than the last one that was interrupted, obviously, by the pandemic there. This is just another way of showing it. Again, a little outdated, but we're at about 155 in yields. The market does not expect us to reach that peak we saw last cycle. Recall, the Fed raised the federal funds rate to 2.5, and they were already cutting. They cut back to 1 3/4 before COVID, acknowledging that was a level of rates that was far too high. Right now, the market's kind of pricing them to go back to the 1 3/4 to 2% range. And I will say that the one uncertainty that we face today it's notable for your portfolio is there's a lot of speculation the Fed won't go that far or can't go that far. Recall now that we have $30 trillion of federal debt and a significant amount of corporate debt that was not here the last cycle, which might mean, especially with home prices elevated, that we might be just a little bit more interest rate sensitive as an economy, which just doesn't require as much in the terms of rate hikes to slow things down and frankly tighten financial conditions or cause some pain to people with that debt. However, inflation is quite high. We expect it to reverse back over the next year and a half, 2 years, but we don't know what we don't know. So there is a small chance, I'd say, that the Fed has to go further. And of course, if they do go further, that's likely the sign that they're going to kind of have to break something to get inflation back under control. So that's not a good outcome. But that's kind of the balance of risks. But we definitely see and are priced to going back to the pre-COVID level.
So with that, the reason we'd just like to give that backdrop is there's the goal with building a strategy for the county is to be able to manage through various interest rates. And so that's by understanding these buckets, the highly liquid, the liquidity, and the core, that's our focus, and making sure that the right size of each of those buckets is the optimal balance for the county. So we're not here predicting rates. No one knows for sure what's going to happen to rates. We can give the history, we can give the expectations, but the goal is to get your portfolio shored up and balanced in a manner that will be able to move properly with those interest rate changes. So the summary, this was as of December 31, which you already tapped on, but the high balances in liquidity was your tax turnover. So we're letting that flow through. The second tier of liquidity is your laddered portfolio, and then the core investment portfolio, they are at 142. And we're going to maintain the 0 to 5 benchmark as you have currently been managed in that. We believe that's going to be the right benchmark for you once we do the analysis. So the main question will be looking at increasing that size from your excess liquidity balances. So just for the actions of approval from the Board of Finance, there's a summary of the strategies that we will be implementing. You have several maturities in the liquidity ladder. We'll be rolling those until further analysis on that strategy. The operating core, same thing. And then the highly liquid is being managed by the Treasurer's Office within the bank accounts that you have. And then we'll be reporting that now within our report, whereas before that was a secondary tier. So I think that's a big added value we'll be able to present to you, is we'll have all of our reports in one package, and you won't have your banks over on a side report. We'll look at it very holistically. So I'm not sure, that's the proposal that we're presenting with the bond proceeds, where there's laddered portfolio maturities coming up, and we're taking the direction of the county manager's office on where those get placed, and then presenting that to the treasurer for reinvestment. And that is it for our report. And everybody get ready for the policy, because that's always fun to go through policy. So we're ready.
Thank you.
Great, thank you. Thank you, Deanne and Garrett. That was great. And we stand for any questions and discussion from the Board of Finance.
Commissioner
Chair.
Benson. Yes, sorry. couldn't see.
Yeah, Madam Chair, thank you. I just want to clarify that with the bond investments that we've got, it's a relief to have higher interest rates, but just so everybody is aware, with inflation where it's at, we're still, the purchasing power of our dollars are still losing money. We're losing about 6%. If we're at 1.5% bonds and inflation is 7.5%, which some calculations have it higher than 7.5%, but let's say minimum 7.5%, we're still losing 6%. So I'd much rather have 1.5% bonds than 0.15 or whatever it was. But I think everybody should just be aware that the money that we're working with, and then money that the projects that we have and that we need to spend money on, those are going up. Those projects costs are going up with inflation also. So yeah, it's not a great scenario. Inflation this high is not a good scenario. And the gentleman who was speaking for GPA just a second ago, he had mentioned that, the Fed's possibly raising rates and we don't know, like Miss Woodring said, which is, she knows her stuff. She's very accurate, but it was mentioned that if they do raise rates, something's got to break. and that could have economic implications also. Now, that's outside of our control, but something that we should all be aware of. So I just wanted to add some additional information to this presentation. Very good, by the way, Ms. Woodring.
Thank you.
Good information.
Thank you.
If I could add to that, this is Garrett. That's a very important point because the Fed was hoping that inflation would manage itself, because the only way the Fed can actively get inflation down is to crush demand, to hike rates to the point where it causes so much pain that people stop spending, people feel negative about the outlook, people get laid off, and you basically hit the reset button. That's not what they want, but it turns out that, in my view, stimulus was too large and too broadly distributed, and that's why we are leading ourselves down this path. And so that's why they're being more patient than they probably should be, given the math is they know what happens if they go this path and aggressively go that route. So we will see the economy is cooling on its own because we are not repeating stimulus, thank goodness. So hopefully this does right itself, but to your point, Mr. Benson, it does not have to. And if the Fed has to aggressively step in, not a good scenario.
Yeah, Mr. Cuddy, thank you. And yeah, your analysis is great. The Fed for about a year or half a year was saying that last year that inflation was transitory, and nobody I spoke to thought it was transitory. And it turns out it's not, and now they're admitting it's a problem. But yeah, I'm with you. They're not acting aggressively enough, and if they do, the stock market's gonna take a major hit, and it's already down 10%. So yeah, it's a mess. Also, if it does start going down, let's say it gets down to 5%, that's still really high inflation. So this is a problem in terms of managing the resources we've been elected to manage. This is going to be a problem for a while.
Thank you.
I would agree. I would agree, Commissioner Benson, and I think that's exactly why you heard the words of Ms. Woodring, where we talk about having those three portfolios working together. When we came in and set those up, they made sense to have them as separate buckets. But as we've matured those, I think it's now time to mature that strategy, looking at those buckets and looking at how they can work better and get that asset allocation diversified. So we're in a little bit different things. Again, to your point of making sure that we watch out for inflation, making sure that we're not so over liquid that we're losing out on yield and return. So we've been thinking of this for the past year, and I'm very excited to say that I think GPA will be a great partner walking that path with us. And of course, I really encourage your input on the investment committee. That's going to go a long way for us in making sure that we all know what directions we're going, what are the risks, what are the rewards. So thank you very much.
Yeah, thank you, Madam Treasurer.
Thank you, everyone. I think I have a bit of a follow-up question to that and I'm not sure if anybody wants to answer it, but in hearing that part that like we're losing money, what do we think about the like time frame on that, knowing that like the parts that aren't beyond our control? Do things start to pick? Are we waiting 5 years, 2 years, couple months? Like what's normal? Or
well, that's why, Madam Chair, great question, but that's why we also have those portfolios that have different maturities and different lengths. So we can have a very robust investment portfolio. We're not going to stick everything in the 5-year bucket in the core because we do want to be able to take some action on things closer, things in the middle. And then with being over liquid, we can use some of that money when we see something pop up and go, oh, that would be a great one. Let's buy that. Let's invest it. So we have a lot of flexibility. We just have to keep watching. Deanne, maybe you wanted to say something to that?
I was just going to touch on that. The losing money always is a scary thought and a scary wording. It's really the purchasing power, and that's something. If there is inflation, it's not. We'll be managing the portfolio based on current rates and the structure of your portfolio. It's really the purchasing power that all of us are losing on the dollar as inflation moves up. So just to kind of rephrase that, it's really the power of the dollar and the growth. And everybody's facing those higher costs. There's just a lot of moving parts. So to the treasurer's point is by being fluidity, if we know that there's additional costs that are coming in, we're going to be able to adjust those portfolios and bring the investment portfolio down and bring back up your liquidity. So it's really having more of an understanding throughout the county organization on what's going to get how you're going to be impacted and what we need to adjust on the portfolio side to have them work together. That's what keeps you safe.
Yeah, thank you, Ms. Woodring. Madam Chair, to clarify, the lack of purchasing power is just our balances will go up. It's just what those balances can pay for shrinks. So in essence, you're losing money, but we're not really losing money. It's just we're losing purchasing power with the money. And our investment options are limited also. You can't, just pick a stock and start, or Madam Treasurer and I, we're both following cryptocurrency. We can't do that stuff. So our options are limited.
And Madam Chair, if I may add, this is just how tricky the last 2 years and even the last few months have been. Believe it or not, inflation is what is causing the problem and causing the surge in bond yields. Yet the TIPS market, which protects you from inflation, is underperforming the aforementioned bond market. So even what would have been the safety valve is actually underperforming on a return basis from the you couldn't make this stuff up. You couldn't predict this stuff, but it's a wacky world out there. But and I will just say that inflation has been higher and stickier than people had thought, but there are still credible analysts and folks that think it might go actually lower than pre-COVID, just given the nature of the inflation is almost 80% in the goods sector. And we overconsumed goods with the stimulus and the lockdowns, right? Goods spending was 40% above trend, while services was well below. So there is some prevailing theory amongst notable economists that think that now people will stop buying goods for a while, and that might actually put deflation into that category. We will see. It's absolutely murky, but it's going to be wild going forward, but it's not a comfortable position currently for sure.
Thank you so much. Very helpful, all of the conversation to me. Thank you. Any other questions for our treasurer or our new team members? Awesome. Thank you very much. And thank you, Commissioner Benson and Treasurer Burse.
Thank you very much.
Great. So whoops, almost messed up myself again. So I believe if that's, we have the advice and consent quarterly investment strategy. That was already.
Madam Chair, we presented that, but we do have it there as a motion for you and the board to give us your consent on the strategy we've outlined for the next quarter.
Okay, great. I move to give advice and consent to be proposed quarterly investment strategy as outlined in the Board of Finance report. Can I please have a second?
Okay.
Thank you, Commissioner Benson. Madam Clerk, please call the roll.
Commissioner O'Malley,
Yes.
Commissioner Casada,
Aye.
Commissioner Piscotti,
Aye.
Vice Chair Benson,
Aye.
Madam Chair Barboa.
Aye.
So called.
Passes unanimously. If there's not any further questions. Thank you again to our presenters. And the next Board of Finance meeting will be Tuesday, May 24th, 2022 at 4 p.m. and it'll continue to be a Zoom meeting. There's no other business. This meeting is adjourned.
Thank you, ma'am.
Thank you. See you in a minute.
Bye.